Hello and welcome to How to Invest. Today we're looking at the Honest Company. I just recently bought some shares of this company after listening to one of Jeremy LaFay's video. I think that's how you pronounce his last name. I did a deep dive on my own. I looked into the financials, I listened to the latest earnings call, and I decided that this was a good buy for me at least. And I just want to go over what I learned, deep diving it, and present that to you. A little bit about me. I'm a stock analyst for a holding company that has a little over $6 million under management, as well as a $100,000 personal portfolio. First off, this is a stock over the last year, barely up after this massive pullback after this last earnings. And that is because there was lower than expected revenue growth due to a lot of the sales being pulled forward into Q1 because of tariff fears. So a lot of their retailers bought up additional inventory, and so that had a little bit of a drag on this second quarter of the year. But I don't think that really affects their long-term story. So we're looking at a 1.127 price to sales. And that is really cheap, especially compared to their peers. So if we just go look at one of their peers, Kimberly-Clark, they have the Huggies brand. So it's like a diaper company. They make wipes, they make skincare, they make a bunch of different stuff. They are trading at a 2.3 price to sales, and I think that this is a far less compelling company than the Honest Company, and you can see they're trading at half the price to sales as they are. As Kimberly-Clark is. So I think Honest Company is honestly at a really, really attractive valuation right now, and that is a big reason why I decided to buy. So we'll just go over our spreadsheet and kind of go what I learned. So the Honest Company, just a little synopsis. Again, like I mentioned, they create baby hygiene, household skincare products, but they have this really, really high standard for what they put into the products. You know, things like chemicals and stuff. They have a much higher standard than even the United States or the European Union has. And I think honestly that is a massive tailwind for them, very accretive to shareholder value, because I do think there is a general secular trend towards being more aware of the type of things these companies are putting into the products we use day to day. And especially for babies, you know, moms are incredibly protective, and if they know and trust a company is not putting anything that can harm the baby, skin irritation, or even through absorption through the skin, be harmful for the baby, you know, moms are making those decisions more and more today as the education of the damage these like chemicals that, you know, historically companies have been using put in these products. You know, I think that's a massive secular tailwind. And it shows in their growth. They're going faster than the industries that they're in. They're taking market share. So I think that's very indicative of the company's business model being successful. So the company's mission is to create safe, effective products. The way I view the acute customer pain that they are solving is many of these products, like I mentioned, are dangerous, have dangerous chemicals, and so they make them safe for you, safe for your skin, you know, safe for your family members. So they have diapers, wipes, bath and body products, skincare products, makeup products, baby clothing products, and cleaning products. So a massive range of household products and skincare, all that kind of stuff. So they have a very, very diversified portfolio of products as well. And so the middle business model, they do have an online store that they sell direct to consumers. I think the margins are a little bit worse on that because of shipping costs. So they're focusing more on their brick and mortar retailers. I think mainly they sell through retailers like Target. So you know, next time you're in Target, see if anyone's picking up any Honest products. I know I'm going to be looking out for that next time I'm in a Target to see what their shelves look like, what those Honest products look like. Continuing to test my thesis on this company. So next, the founder CEO background. This is not a founder-run company. It was founded by Jessica Alba. She is still on the board, however. So, you know, you definitely want to see, you know, founders, the visionaries of these companies still being involved in the company. You know, obviously Jessica Alba is not a businesswoman, which is fair enough. She, I believe, is an actress. But she brought in a very, very competent CEO, Carla Vernon, who's now the CEO and has been for, I think, the last 2 years or so. And she's been doing an incredible job. So she was the vice president of consumable products at Amazon previously and an executive at General Mills. So she has lots of experience in these areas of these type of household products. So just going over, kind of a bear case real quick, risks, threats, kind of a worst case scenario, what could happen to Honest Company. You could see growth stall out. They just released a new diaper product, so we could see that diaper product flop. And you could see, they've been improving margins really, really well the last couple of quarters. And you could maybe see that margin improvement stop and maybe even turn around, though I don't actually see any of these happening. Those are just some things that obviously would harm the business. But I think the bull case, which is the much more likely scenario for this company, is that says secular adoption of cleaner, safer products continues to increase, creating a tailwind for Honest, and management continues to get better and better margins. They've improved the gross margin from something like 27% all the way up to 40%, which is absolutely incredible. And they've been using all of that additional gross profit to reinvest in growth, in research and development. So this is exactly the type of future investment, margin improvement. These are all really, really impressive things that you want to see. These are very good fundamental things you want to see in a company. So and they're continuing to increase marketing, and you'll see sales continue to increase. This is a stalwart, so it's not really a fast grower or anything like that. But I do think the biggest thing for this company is it's just really undervalued. Like I showed, compared to its peers, Kimberly-Clark, it's half the valuation multiple that it really should be trading at, and maybe even a higher, valuation multiple compared to Kimberly-Clark. Because this is a much younger company. It's growing. Actually, let me double check the growth rate at Kimberly-Clark real quick. I just pulled up Kimberly-Clark's revenue numbers, and oh my gosh, there's no way that Honest should be valued so much lower than Kimberly-Clark. Kimberly-Clark has literally been shrinking for over the last year in terms of revenue, and is twice as expensive as Honest Company is compared to their sales. So we really should maybe see even a 4 price to sales for Honest, which would mean almost a 4x in the stock price, sending it well past its November 25th, 2024 high there. So this is really set up for probably quite an explosive breakout, looking just at the technicals here. Obviously, technicals don't really matter. What really matters is the fundamentals, and the fundamentals are saying this company should probably be worth 4 times what it's trading at right now. So and that opinion is shared by Jeremy as well, and I think he's found a really good stock pick here. Past revenue growth has been inconsistent here. I'll just pull that chart up a little bit, talking about year over year. So some quarters where it's 1%, some quarters where you have a good 15% growth in revenue. This last quarter was a 0% year over year, so it's comping against this quarter here. Again, and that was management was saying it was because of the tariff headwinds, just some pre-ordering of products. So we'll see if that continues the second half of the year. They think it will a little bit, but again, I don't really think that is a long-term threat to this company. So yeah, really strong growth. Analysts are only expecting, let me pull that up real quick, 5% for this year, which is about the lower end of management guidance. Guidance from management is 4 to 6% year over year growth for this year. And the next year only 4.72%. That's what the analysts are thinking. I think they are really low, especially, I think we could have seen the continuance of this, these 4 quarters, which ranged from 9% to 15% revenue growth. I think we would have continued seeing that throughout this whole year if it wasn't for tariffs. And I have no reason to believe that it won't resume in the following year. So we'll go over my modeling for this company a little bit later, but I think that they could easily get back to these 10% growth numbers in 2026, and maybe even the Q4 of this year, depending on how tariffs kind of play out. But yeah, so an average of 8% around there in the last 4 quarters, and pretty solid growth all around looking historically. Free cash flow has been flat, but that is because they have been putting a ton of money into growth, which is what we want to see. They consistently beat analyst expectations. That's why I'm even more confident that they will beat these analyst expectations of 4.5% and 4.7% in 2026. I think those numbers could easily be far higher than that. I'm modeling a little bit higher, and I think even I could potentially be a bit conservative in my modeling. So they have their new diaper product, and their increasing marketing spend is how they're going to achieve that growth. And again, just the secular tailwind. Again, parents don't want these, old products that, these companies don't care what chemicals they're putting in. It's irritating skins. People have far more allergies nowadays than they used to. So people really want clean products that they can trust and know is not going to harm them. So yeah, it's only at a $400 million market cap. And again, we'll look at Kimberly-Clark because I think that's probably what you'll see. So $45 billion market cap for Kimberly-Clark. That is not too crazy to think. So that could be a 100x for a company like Honest. Might take them quite a few decades to get there. But yes, I think that is in the realm of possibilities for sure. So yeah, very, very small fish in a big, big pond, which is what we want to see. So they actually have a very strong balance sheet, total assets of 250 million and only liabilities of 62 million, which means they have an enterprise value of 250 million, which now looking at that compared to the price to sales, now you're talking about really you're buying at this company for a price of sales of less than 1. They have more sales annually than their enterprise value because you're getting all of this assets for free basically when you're buying the company. So really, really undervalued in my opinion. Revenue, again, trailing 12 months, as you can see, yeah, far, far higher than the enterprise value. So very, very undervalued. Again, gross margins of 40% almost this last quarter. So really, really impressive. And they're able to leverage that gross profit. Obviously, you have to pay operations after that, but into growth. And that's not hitting the bottom line yet. As you can see, the net profit is only 1.6%. But I think that's on purpose as they're reinvesting that into growth, which is what I want to see. Obviously, you got to turn that into profit eventually to make a return for shareholders. But I'd much rather than being investing in growth because I'm not a dividend investor. Eventually they'll have to turn that into net profit to be able to pay out dividends, which is kind of the late stage for the company, but it is in that growth stage. So having low net margin is actually far better because it means it minimizes the amount of taxes that they have to pay. So I have no problem seeing a profit margin that low. And even with that really low 1.66 profit margin, competitors like Kimberly-Clark have around 12%, if I remember correctly. We'll see that in a bit as we go further down the spreadsheet. So this profit margin could be super, super high at some point, 18%, because they already have better gross margins than Kimberly-Clark as well. So they're just not pushing that to the bottom line yet because they want to reinvest in growth, which is what me as a growth investor wants to see. But yeah, with this 1.66 net profit margin, they're only trading at a 70 trailing 12-month price to earnings ratio. Which you could see is a little bit high compared to the market average, but when you consider that their net profit margin is so low, they're just not focusing on that bottom line. You should really be looking more at the price to sales as kind of the metric to value this company, and that metric they are incredibly undervalued. So yeah, the spreadsheet's slightly different than what I'm seeing on Webull, and that's just perhaps because these numbers aren't exactly the same, but they're close. Yeah, enterprise value to earnings, again, if you back out all of that equity, shareholder equity they have, that already drops the PE to 38, and then looking at the price to sales, super, super low, and we should really have enterprise value to sales, and that would be even lower. That would be below 1, like I was mentioning. Price to book, again, even that is pretty cheap, and you have competitors like Kimberly-Clark. I know I keep pounding on Kimberly-Clark. They are trading at a 35, if you look here, 35 price to book. So They are, yeah, I just can't believe how undervalued Honest is. 10% of shares are shorted. The free float shares are shorted. So, if we start to see a correction in the stock price, you could see some kind of short squeeze. Probably nothing crazy. You really want to see a much higher percentage. GameStop was like over 100% of free float shares were shorted. So, but important to note, why undervalued? So yeah, again, it's just super undervalued compared to its peers in terms of sales, and it even has a higher gross margin than their peers. So we'll look at some of these charts in a minute. So total addressable market, they stated it was around 80 billion. And they have a ton of products, so in different household verticals, makeup verticals, so this could be even conservative. This is just a number they mentioned in the earnings call, but this could have been just about diapers. I don't exactly remember, but either way, they are a small fish in a very big ocean, so they have tons of room to grow. Again, market growth is very hard to pin down because they do have so many products and so many different verticals. They're all growing at different rates, but it's not a fast-growing market. It's in the low single digits for sure. And the important thing is that they are growing faster than the market is growing. So they are currently taking market share. So again, so talking about their moat, they are high standard for the additives they can use in their products. The consumers trust, consumer trust is their moat. There's a secular change wanting to have cleaner products. It's not easy for these incumbents, these legacy companies, to just quickly change out. They have whole manufacturing lines, so it's built up from the bottom around these clean products. So that's kind of their moat, the trust that they're already building with clients and customers. So yeah, they don't really necessarily have any of these first moats, but they do have a disruptive business model, and that is being a focus on clean products. So industry mature market caps, obviously Kimberly-Clark, again, 45 billion. So, you could see 100x if we get to the size of a Kimberly-Clark. Gross margins for Kimberly-Clark is 35% gross, 15% operating, and 13% net. So we're already seeing better gross margins from Honest. So you could see better margins on these lower ones as well. So PE for Kimberly-Clark is around 19 right now, a 2.4 price to sales, and a 35 price to book. And that is compared to much lower price to sales on Honest, and again, even lower price to book. So all right, let's look at the modeling we've done. So current trailing 12-month revenue is around 400 million. They are guiding 4 to 6% revenue growth for this next year. I think that's conservative, so I just went with the higher range of their revenue growth. So 6%, and I think they could probably continue that 6% or even accelerate revenue even beyond 6%, but I went with 6% for the next year as well to be a bit conservative, and then slowing down to 5%. Again, I think these are really conservative. You saw many quarters of 10 to 15% revenue growth. But I just went ahead and kind of modeled them out at 5% revenue growth for the next 20 years, which I think is really, really conservative. They could far outpace that. That's 5% growth is the growth rate of some of the verticals they are in. So that would just mean they keep the exact same market share and they continue to grow with the verticals they have products in, which I think is incredibly conservative, as they are currently taking market share and growing faster than the verticals they are in. So I think this is really even sandbagging on my part for these revenue growth expectations. They currently have a 1.6-ish, little below 2% net margin. I think the reason, again, like I mentioned earlier, is because they are focusing on growth. So we could see that up to 5% in 1 year, though I don't really expect it to go there yet. It wouldn't actually be that smart for them to raise it to there right now, because it just means they have to pay more tax. It'd be far better for them to reinvest it in growth, in product. It really makes the model look really bad because our model is based off of profit percentage and a P to E ratio. If we did this based off their price to sales ratio, I think it would be a little bit easier to model out, but I don't expect to see 5%. What I'm saying is I don't expect to see 5% profit margins in 1 year, but I think it could be realistic in terms of a look-through profit margin. If we did a look-through profit margin for all of this, which I think they could get to 18%, let's just look at that. I think this is their look-through profit margin in 20 years. They could easily have a 18% profit margin. So if we look at an 18% profit margin look-through, that's saying the company needs to 10x to get to a fair market value. If they're kind of trading at a similar PE, a little bit lower, so 68 to 60. So if we did a look-through PE, they're trading at like a 6 look-through PE. Basically. So really, really undervalued. Maybe that's a little bit more reasonable there. So anyways, yeah, I think there is a lot of short-term upside as well as long-term, just really good company. Let's see, why is it giving me, that's just as multiple compression continues to go down. So yeah, I think you could see a lot of upside in the short term. We'll put these back down to a little bit more reasonable profit percentage margins. Yeah, so they're at a 68 PE. They could start to compress in 1 year to a 50, a 40, a 30. The Kimberly-Clark trades at a 19, so you could definitely see a little bit higher of a PE than that in 20 years. So just assuming that, let's look at the return on investment over 1 year, 5 years, 10 years, and 20 years. So I think it's about definitely undervalued right now. You could see the fundamentals, in my opinion, should say it's should at least double in the next year or so. 3.7x in 5 years, 5.3x in 10 years, and 8.7x in 20 years. Remember, I am super conservative on the revenue growth. I think the revenue growth could easily be far, far better than this. So if you weren't so conservative on the revenue, this could obviously be a lot higher. Either way, even on my very, very conservative revenue growth, they are beating the S&P 500 in the 20-year, definitely over twice the growth over 10 years, far, far better in the 5-year, and insanely better in the 1 year. So this is a definitely a company I would be happy holding for the next 20 years. The biggest thing that just makes it a no-brainer is just how undervalued it is at the moment. And then if you do see a acceleration of revenue growth, which we kind of have been seeing, so if it is higher than my projected 5% kind of average over the next 20 years, which I think it most likely will be far higher than 5% average, because that's basically just the market, the industry growth rate, and they're growing faster than the industry growth rate. This could be a 15x in 20 years or 20x in 20 years, maybe even a 30x in 20 years. So no, I'm really, really liking Honest Company. I am really happy to have added it to my portfolio. And just finally, we'll do the final best buy checklist. They are innovative. They are pioneering this super clean product space. They are a generational leader in that space of clean products. They have top fundamentals, incredible balance sheet, incredible margins. It is not founder run, but the founder is still on the board. It is more than 10% insider owned, which we love to see. We love to see insiders aligned with shareholder interests. They are disrupting, again, because they are bringing this clean products to the market, whereas traditional companies really don't care. You could definitely see a 30% plus return, though that would probably be on the higher end, so I might just go ahead and flip that over to false actually. But it is very, very undervalued, and there actually has been insider buying, so I'll go ahead and show this here. So the last 3 months, there has been 500,000 shares bought, insider shares bought, and insiders have only sold about 200,000 shares. So insiders are definitely thinking that the company is undervalued, as well as they are in the last 3 months have been buying shares, net buying shares more than selling. So I hope you enjoyed. I hope that this was very educational and entertaining for you. Please leave your thoughts in the comments. Maybe something I missed, maybe something I didn't mention about the Honest Company. We'd love to hear your thoughts in the comments. So thanks for joining me today, and we'll see you on the next one.